Welcome students and scholars. In this final concept video of ASC 105, we move from accounting ideas to financial statement mechanics. So far, we have studied GAAP authority, codification research, materiality, and the conceptual framework. Now we ask two practical questions. When does an item enter the financial statements and at what amount? Recognition answers the first question. Measurement answers the second question. This is where abstract accounting theory becomes visible in the numbers that users actually read. Once we understand recognition and measurement, we are ready to move from ASC 105 into future standards where these ideas are applied in detail. Recognition means formally recording an item in the body of the financial statements. It is not just a note, not just a management discussion, and not just an internal calculation. Once an item is recognized, it enters the primary statements such as the balance sheet, income statement, or statement of cash flows. Recognition requires both words and numbers. A label without an amount is incomplete, and an amount without a proper description is not meaningful. Most importantly, recognition affects totals. It can change assets, liabilities, revenue, expenses, net income, equity, or net assets. That is why recognition is a gateway into reported financial reality. FASB Concepts Statement Number 5 gives us a useful recognition filter. Before an item is recognized, it must pass four tests. First, it must meet the definition of a financial statement element, such as an asset, liability, revenue, expense, gain, or loss. Second, it must be measurable with sufficient reliability. Third, it must be relevant, meaning it can make a difference to users. Fourth, it must be faithfully represented, meaning the amount and description should be complete, neutral, and free from material error. Notice the discipline here. A business event may feel important, but if it cannot be measured reliably, recognition may not be appropriate. After recognition comes measurement. Recognition asks whether an item appears in the statements. Measurement asks what amount should be assigned to it. GAAP does not use one measurement basis for everything. Some items are measured at historical cost, which is the original exchange price. Some may involve replacement cost, market value, net realizable value, or present value. The measurement basis depends on the standard, the item, and the information objective. This is why learners should avoid one size fits all thinking. The same financial reporting system may use different measurement attributes because different items communicate useful information in different ways. Present value matters because cash in the future is not economically the same as cash today. If someone offers you $10,000 today or $10,000 3 years from now, the rational answer is normally today. Why? Because money today can be invested, used, or protected from future uncertainty. A future payment also carries risk. Will it be collected, paid on time, or affected by changing conditions? Present value converts future cash into today's equivalent amount by discounting it. In simple terms, discounting removes the time premium from future cash, so amounts from different dates can be compared more meaningfully. Let us use the Notline tools example. Suppose Notline expects to receive $12,000 after 3 years and the appropriate discount rate is 6% per year. The present value formula is $12,000 divided by 1.06 raised to the power of 3. That gives a present value of about $10,075. In plain language, $10,075 today is economically equivalent to receiving $12,000 in 3 years at a 6% rate. The difference of about $1,925 represents the value lost by waiting for the future cash flow. An annuity is just the same present value logic repeated across equal payments. Think about lease payments, bond interest, pension payments, or structured settlement receipts. If the same cash amount is paid or received at regular intervals, each payment is discounted back to today based on when it occurs. A payment received after 1 year is discounted for 1 year. A payment received after 3 years is discounted for 3 years. Then the present values are added together. We do not need dense annuity tables to understand the intuition. An annuity is simply multiple single cash flows, each discounted separately, then totaled. Expected cash flow thinking becomes important when there is not just one certain future amount. Suppose the future cash flow could be $8,000, $10,000, or $13,000. Instead of choosing only one scenario, we assign probability weights to each outcome. In this example, $8,000 at 30% gives $2,400. $10,000 at 50% gives $5,000, and $13,000 at 20% gives $2,600. Added together, the expected cash flow is $10,000. This probability weighted amount can then be discounted to present value. Liability measurement needs extra caution because the measurement objective can be more complex than simply valuing an asset. A liability may be measured based on the amount needed to settle the obligation directly with the creditor or the amount another party would require to assume that obligation. The entity's own credit standing can also affect liability measurement, which may feel counterintuitive at first. For some fair value measurements, a decline in credit quality can reduce the fair value of certain liabilities. This does not mean the entity is healthier. It means measurement is reflecting market assumptions about settlement, transfer, and risk. The interest method connects present value to future periods. When an asset or liability is initially recorded at present value, that amount usually changes over time. The carrying amount may grow through accretion or decline as payments are made. Under the interest method, the effective interest rate is applied consistently to the carrying amount. This produces interest income or interest expense in a way that reflects the original discount rate. You will see this logic again in later topics such as leases, bonds, long term receivables, impairment measurements, and other standards where timing of cash flows affects reported amounts. Let us quickly recap the ASC 105 foundation. Video 1 explained GAAP authority and why the FASB codification matters. Video 2 explained how to research the codification through topics, subtopics, sections, and paragraphs. Video 3 explained materiality and the conceptual framework as the discipline behind professional judgment. This final video explained recognition and measurement, including CON 5 recognition criteria, measurement attributes, present value, expected cash flow, liabilities, and the interest method connection. Together, these ideas form the base for studying all later ASC topics. Whenever we learn a detailed standard, we will keep returning to these same pillars. Now the ASC 105 foundation is complete, and the next natural step is financial statement presentation. Recognition and measurement tell us whether an item enters the statements and at what amount, but presentation asks where it appears, how it is classified, and how the complete financial statement package is assembled for users. That is why ASC 205, presentation of financial statements, becomes the next logical topic. If this ASC 105 series helped you build clarity, please like the video, share it with your colleagues, and subscribe to Commerce Regiment. In the next series, we move from principles to presentation.